All right, investors, it's time to take another look at Paramount Global. Now, I've owned this stock before, and I took a loss on it. Probably owned it from $29 to about $24 a share, and decided to clear out my position. But I think it's time now that it's gone all the way down to 16 to take yet another look to see if possibly the stock is a good investment once again. So I'm going to tell a little bit of a story. I might tell you some things you don't know, probably some things that you do know, and I'll see if I can combine them and to figure out whether the stock is a buy given recent changes. So first, I'm going to start the story as any stock story starts with price. I'm going to use stockanalysis.com to determine the outcomes or the values of almost all of my information here. Brief look at the company. The very first thing I like to see is this revenue and earnings chart down here. It's just a quick overview of what the company's been doing in the last 8 years or so. So the company, year on year at least, or at least annually, not year on year, is making money and having somewhat of an increased revenue. However, we're going to be diving a lot deeper into the numbers to see if the trend is actually positive or negative. Quick valuation metric here. Currently, the company is trading at $10.5 billion. The enterprise value is actually a lot higher than that. It's at 25.72, which tells us that the company is sitting on a net debt of about $15 billion, which is $5 billion more than its market cap, 50% more than its market cap. So it's got a lot of debt to work through, and that's going to become a problem in a little bit. You'll see it's one of my main concerns with the company. Next thing I like to do is go into the financials, hit it up to quarterly so we get some more definition into the numbers, and then start with the very top line, the revenue. Since some mergers here in 2018, the revenue has been very, very slightly increasing, but basically holding steady overall, around the $7 to $8 billion per quarter. The cost of revenue, though, has been increasing. So it's taking a lot more money to create that revenue for the company. In fact, in the last quarter, they spent $6.6 billion to generate just $7.25 billion. It's a problem. Gross profit was extremely low, 627, given those previous figures. Operating income the last quarter is actually negative $1.3 billion almost, after a series of declining earnings in the quarters. You can see it very smoothly expressed in the net income figures here. You can see the quarters dipping. Shares outstanding. What does this tell us about the story of the company? Well, they were buying back shares from 2013 all the way to 2018 when things started going awry here. And then a big boost in 2019 for acquisitions, mergers and acquisitions, raising cash, etc. And then ever since, the trend has actually been to sell more shares into the open market and dilute the ownership of the shareholders by a tiny bit, granted. The profit margins have been looking really rough in the last year. So they started some kind of repair all the way into 2021 December, but then 2022, although a rough year for most stocks, especially stocks that are focused on growth, which Paramount Global was focused on growth through at least subscription services, trying to make that happen with some success, might I add. And we're going to look at some graphs of that in a second. But it looks like it's hitting some kind of trouble here. And moving further down, the next thing I like to look is the balance sheet real quick. We're still on quarterly. This is the number that concerns me the most. Do you see how in 2021 their cash and cash equivalents are 6 billion, 6.2, 5 billion, and then 5.3 4, 3.4, 2.8, 2.1. So this company is bleeding about 700 million per quarter. Bleeding 700 million of cash per quarter. Okay, so that's pretty substantial hurdle to come over. A lot of that happens, whenever there's a big giant. It's hard to rein in costs. You end up depending on people under you, right? You delegate. You have previous leaders of the companies that you merge with continue to work, or maybe you have some kind of shuffle. Things get stay unaddressed. You can't really cut any kind of fat very effectively, and you end up with this big inefficient machine that's just really hard to control. And that's one of the risks of becoming a bigger company through acquisition. This behemoth who actually isn't even competing when it comes to size with giants like Amazon Prime or Netflix. And so I don't know. I'm questioning, first of all, the strategy of trying to gain size just purely through acquisitions. It seems at least challengeable. I'm not saying it's not the right way to go, but at least it's challengeable, right? I mean, Netflix managing to grow internally. It's got its own, studios. Yes, it bought up a bunch of content, but now it's creating a lot on its own, trying to figure things out. So even if it is the right way to go, perhaps there needs to be some kind of clear, streamlined integration process, and instead of just slapping different companies into their streaming service. It just seems like a very inefficient way to try to bring that flagship business to the forefront. So speaking of this flagship business, why don't we talk about it a little bit? All right. I'm not gonna go through the rest of the balance sheet. Basically, total assets 56 billion, total liabilities 34 billion, total debt. This is the number actually I want to mention before I move on to the streaming service. Total debt, I like that they're trying to reduce, but just the fact that they have so much debt, right? They sold a bunch of equity, got into debt to make the deals, but it was like $21.8 billion at one point, and even now $17.25 billion is just a lot, especially for a company that has an enterprise value of 25 billion. Its market capitalization is 10 billion. That's a lot of debt for the company. And it's not a bank. It's not like they're using their debt that productively, right? They're not dependent on, collecting interest and either taking a default or not. Like, they're funding all these projects. They're funding like permanent employees. They have a lot of overhead, a lot of operational costs, right, to deal with. How about we look at some of these liabilities? Long-term current debt, deferred revenue, accounts payable. I mean, and the thing is, it's accelerating, right? Now they got even more people on payroll. So anyways, that's concerning. So before we move any further, as I mentioned, let's take a look at the streaming service and see how that's doing. Okay, so this chart is actually from 2023, January through March. So this is very, very really recent. And what you can see here, let me remove my camera real quick, is those three dots are, I think, the month growth in market share from all the biggest streamers. And the two ones that are growing are Amazon Prime and Paramount Global. Paramount Global is the fastest grower, which is awesome, right? They almost, their next competitor is going to be Hulu, unless Apple TV manages to pass them, but Apple TV doesn't seem to be growing. So they could perhaps beat out Hulu at one point, which would be awesome for the platform, but they're like number 6 right now in size. And they have 1/3 the subscribers of Amazon Prime or Netflix. just to give you an idea of where they're at. But they are the fastest grower. Other things about Paramount's streaming service, their flagship business now, is that it's grown quite a bit from Q1 2021 to Q1 2023 in the last 2 years, from 16.5 million subscribers to 60 million subscribers. That's great, and what I want to mention about that is the streaming business actually, it's really good because if you have size, because anything you do scales up. Like if I do all this work, just to give you an example, a little detour as to why numbers are so important for these streaming services. If I make a movie, right, and I do all this work and I hire people and I have this awesome production, something that's lacking from this channel. And anyway, let's say I spend, $10,000 doing it, okay? And I make make a video, and let's say I sell it to one person for $10. Well, I mean, I've done all this work. I've spent $10,000. I've committed all my personal time for 2 months, and then I get paid $10 for it because I only managed to sell to one person. That's my entire audience. But now, let's say I convince another person, right? That's already $20. I just doubled the money that came in. I doubled my revenue without having to do this entire movie all over again. You see what I mean? So what if I now find 10,000 people somehow to buy my video or my movie, whatever I produced? I'm already making 10 times as much money in revenue as I spent on the movie without having to actually make another movie. I don't have to make the movie for all these people, so it scales infinitely. If 1 billion people decide to watch my movie, right, then I have 10 billion revenue with $10,000 cost. So you see how numbers are extremely important for streaming companies. So I see the drive to acquire more subscribers, but at what cost? And for how long, are they going to be pushing this? But results are there. They are the fastest grower. When it comes to Analysts, in the recent turn of events, there's news, like this article here from MarketWatch, that praise Shari, I don't know how to pronounce her name, who basically has sole voting rights of the entire thing, as far as I understand it, for being more, responsible or more focused on actually saving the value of the business and stop, the bleeding, making sure that the business turns profitable again. So they're praising her for her efforts, and it's enough for some analysts to turn from a sell to kind of like a hold. Now, this Sherry person, in case you don't know who she is, I'm actually still unclear. I think she has nearly 100% of the voting rights, but that didn't sound right to me. So what I did was, to continue the story here, is I went to FinViz to figure out, okay, so how many shares outstanding are there? The answer is 651 million. And what's the float then? Well, the float is 584 million, so just a little bit less. So I'm thinking okay, so all the shares of this company are basically public. And then I look at insider ownership, and it's only 0.2%. So I'm like, what is going on here? What is going on? I go naturally to Google. Okay, whoops. And I'm like, all right, so who owns Paramount Global? And it says that it's being owned by National Amusements. I'm like, it says Paramount Global is a subsidiary of National Amusements. And I'm like, hello, subsidiary? Like, they're the big dogs. Who's this National Amusement company? I didn't even know about National Amusement. And then, of course, it tells me, I dig a little bit deeper, and it tells me the whole story about, Sumnar Redstone and his father, Michael, who started the company. And then Sumner's daughter, Sherry, let's call her Sherry, basically has 100% of the voting rights. He used to have 80%, she used to have 20% ownership, and he used to have 100% controlling stake. But now she has basically 100% controlling stake. So the shares that you're buying out there in the open market are not, they're not voting right shares. They're just, apparently, this is the way I'm reading the situation, is you just get the benefit of having, the ownership and rights to the profits and or dividends that they're issuing. So it's a very similar story. It's almost like holding a Chinese VIE, right? A variable interest entity. You don't really actually have controlling, or voting power in the companies that you're owning. You just kind of get to receive some of the spoils from the company. It's not exactly like that, of course. If you own shares of Paramount, you actually do own something, but you cannot vote on it, right? Whereas the VIEs, you don't actually own anything. You just kind of you own a rights to a contract that says that it will share some profits, right? It's a little bit different. But anyway, let's not get derailed here. Back on topic. So, next thing is I mentioned dividends. This is evidence that some kind of fiscal responsibility is in play here. Now, Paramount used to pay quite a big dividend, okay, and he used to raise it even in the face of difficult situations, right? They had 12-cent dividend, 15-cent dividend in 2015 in the heyday, and when they started going down, they kept their 18-cent dividend per share, and then even bumped it in to 24 cents in 2019. So basically spitting money that they don't have into the hands of investors, accruing more debt. This is basically any money that you send out to investors is a failure, right, to pay off some debt. So in my opinion, pretty mismanaged situation here. What they could have done is they could have actually bought more shares. They could have bought back shares with that money if they didn't want to pay the debt, because what that would do is actually decrease their dividend liability in the future, and they may not even have had to cut the dividend later on. But anyways, I digress. I think that cutting the dividend now is, maybe a little too late, but it's a step in the right direction. If it were me, I'd probably even put it at 0. I don't know why they even decided to give 5 cents. Maybe because people who are big time owners of this company need some income or something. But either way, the dividend's down and responsibility and financial viability is back in the focus of the company. And so now some people are betting that the ship is starting to turn around. The Titanic is missing the iceberg. It just grazed it barely, but no hole was punctured in the side of the ship. So that's my analogy here. Whether or not that's true, the jury obviously is still out. The decision whether this is investable or not is obviously very difficult. But the people in control, including Sherry, apparently have enough connections to where they can secure some kind of some funding deals that are favorable. And without digging in further into and breaking out all their debt and the percentage they have on their debt, just in general, any further debt accrued in these high interest rates is going to be very painful in the future, right? They don't not only have to pay that 5-cent dividend, but they also have to pay interest on all that debt that have accrued, right? So we have to remember that. Because the number is so large, it's significant. So you're playing with a very large headwind in front of you. So my personal preference, of course, would be to get rid of and settle some of that debt. And I think people are trying to do that in the management. If we go to the balance sheet, quarterly, total debt, or we can just look at the long-term debt, they're actually trying to settle some of it, right? So since 2020, there's been settling of debt, but I think this has got to be the most aggressive endeavor. Currently, most of the focus is on growing Paramount Plus, which is understandable, and that's fine and dandy because of the elements I described earlier about scalability, etc. But I think this should be like a close number two. Forget about, dividend, cut the dividend, remove the entire liability there, and then focus on shredding this debt to nothing. Okay, let's take a look for a moment to the share issuance. All right, there we go. And I'd probably do the same here, flatline the share issuance, but I definitely try to knock that debt off. So, in closing remarks, I actually, after reviewing Paramount Global for a second time now, I'm a little bit more positive on the company than after I sold it, but I'm less positive than when I bought it, if that makes any sense. So I'm somewhere in the middle. So I'm not bullish enough to buy because of the overhang and the really heavy weight of the debt burden that's going to be with this company for quite some time. But I'm not bullish enough. I'm not bullish enough to buy it again, but I'm also not bearish enough to either outright short it or give it a sell recommendation. You know what I mean? So I think it's going to be a tough path ahead, but if everything goes right, growth of Paramount Plus continues, it's going to give them that profitable threshold that they desperately need, and they can start accruing money. Another thing I would do in conclusion, right, if I was Sherry, is I don't need to grow through all these acquisitions anymore. I would just start whatever kind of studios are running unprofitable businesses, or are heavily unprofitable, or at least where things look like they can't turn around, or it's going to take too much effort or assets to turn around, and that's maybe a flip of a coin. Get rid of it. Raise cash, settle debt, cut the dividend, rinse, repeat. Get rid of all these things. You have enough content. You got the new Showtime deal and everything else, but they've raised their fees for their Paramount Plus program now as well, and that's fine. I don't think the price increases or anything that are gonna murder the subscriber base. But you don't need to keep issuing stock and going into debt to acquire more and more companies that are not even profitable on their own a lot of the times. So those are my thoughts. If I see that, hey, actually, instead of just buying brands and studios, there's actually also sales of studios, then I'd probably become more bullish and maybe even bullish enough to buy the company. If I see that being settled and maybe the dividend even cut down to zero, then I might be a buyer again. All right, but until those two things happen, I just prefer to sit on the sidelines on this one. All right, hopefully that was helpful for anyone interested in Paramount, and maybe you learned something today or not. If you did learn something, let me know what you did, and if you think I missed something, please leave a comment below so I can understand the company better, and I can perhaps improve my investment and research and analysis process. So thanks a lot for that. I'll catch you in the next one. All right, peace.